Hello and welcome back to another episode of the For the Property Investor podcast. And we're here with the weekly news again. Yes, it does happen every week. And of course, the only man that brings us the news is Mr. Nick Bendel. Hello, Nick.
Hello, Mr. Owen Davis. Thank you for having me.
Yes, happy to have you because without you, we wouldn't have the news. So I'd be sitting here just twiddling my thumbs. What have you been up to for the past week?
I've had a great week. Normally, I'm in Sydney, but I'm currently in Perth on a working holiday and really enjoying Perth. It's such a wonderful place. Uh, did a bit of sightseeing, checked out the Quokkas on Rottnest Island, which was wonderful. Been cruising the Swan River. I visited Government House yesterday. The Perth governor or the Western Australia governor opens that up once or twice a year, and I walked around his home. Very nice place. I recommend it. If you can maybe add that to your list of managements with your business leaf field, I would certainly recommend it. And really had a good time. And of course, my business, Hunter and Scribe, a copywriting agency that writes content for finance and property professionals, continuing to work every day. This is a working holiday and got a very nice Google review from a real estate agent client. Nick's understanding of the property industry really stood out. He didn't just write content, he genuinely understood the audience and how to communicate effectively. The quality of the writing was excellent, clear, engaging, and tailored exactly to what I needed.
Very good. Glad to see some people are getting 5-star Google reviews.
And
It's
I was going to ask, Owen, what have you been up to? Your business, Leafield Property Management Business, you're in 5 states, including WA, where I am.
Yes, including WA. Well, maybe I could put you to work while you're over there. Just thought of that. But no, we another short week. So lots of things to fit in within 4 days. So yes, we been busy onboarding new staff as well. So looking forward to the next month or so getting everything going. So yeah.
Well, you have actually been putting me to work. When I visited Government House yesterday, and I was trying to see if we could add that to Leafield's portfolio, I did explain to the governor that if he wanted to get a good rent, he would have to remove all the furnishings because, of course, if it's already furnished, a lot of tenants wouldn't want to live there. So I explained he just needed to get rid of all
Correct.
the 19th century furniture, the paintings of the Queen Mother, George VI, Edward VII. They would have to go. I just said, look, if you really
Yeah.
want to maximize your rent.
Most tenants want sort of good modern furniture these
Mm,
days, and you know what? The only tenants you attract in a furnished property are ones that can't afford furniture. So, do you really want them?
that's exactly what I told the governor. He said he'd think about it.
Fair enough. Well, Nick, have you brought us some news this week?
I have indeed 3 really interesting stories. The first one is stock on market increases from low base. The number of new property listings in March was 3.8% higher than the month before and 5.4% higher than the same month last year, according to SQM research. Again, that was new property listings. At the same time, the total number of properties listed for sale in March was 6.7% lower than the year before. So new listings up, total listings down. SQM's managing director, Louis Christopher, said the data was painting a mixed picture. Some cities are seeing rising new listings, others are pulling back slightly, and price movements are uneven on a month-to-month basis. Importantly, total listings are still below last year's levels, and distressed listings remain low. That combination continues to support prices, even as we start to see more supply come back into the market. The key question over the coming months will be whether this increase in listings gathers pace. If it does, we may see some moderation in price growth. If not, the current supply constraints are likely to persist. So, Owen, as we saw, there's been a rise in listings, new listings, pardon me, between February and March. Do you think that rise in listings is related to the war in the Middle East and the two rate rises, or is it just based on the fact that stock on market was low and therefore could only rise?
Probably a bit of all of the above, Nick, especially with the low amount of stock to begin with. And then, yes, rate rises. People might think, yeah, there's always that thought of, oh, we better get out before the market shifts because rates have risen for the last couple of months. But usually by the time you've recognized that yourself, so has everyone else, and it's a bit too
Mm.
late. So we're hearing from um, many people on the ground that work in the industry that yes, there is a bit of a shift in the market, and yes, if it was anyone wanting to sell right at the top, you might have already lost that chance.
So just to make sure I've understood correctly, if rates go up, people who are maybe thinking of selling at some point in the near future think to themselves, oh, if rates are going up, that's going to take buyers out of the market and therefore prices may go down. And if prices are going to go down, I was planning to sell in 6 or 12 months, but I should probably list my property right now to beat those price falls. Is that what you're saying that some people think?
Yes, they do, and they think that there's a delay in prices dropping. But no, it's prices can drop pretty dramatically when people start pulling out of deals, and yeah, just putting everything on hold until they wait and see. That's what you don't want to be hearing.
And SQM also mentioned a low number of distressed listings. In fact, the number of distressed listings in March was 29.3% lower than the year before. But I'm wondering, with interest rates rising, the cost of living rising, and maybe unemployment rising, we'll have to wait and see on that one. Do you worry there will be significant increase in forced sales?
I don't necessarily think there'll be a significant increase in forced sales. No, it's yes, there'll be people hurting, but most people have still made money from when they've purchased, and it'll be a position of them maybe needing to sell, but they'll still be selling at a profit, or they've got equity in the property. Yeah, the only exceptions might be people who have got in under that 5%
Mm.
government deal. But my advice there is still to hold on as long as you can. And in the end, time will always be your friend with property.
Let's move from the sales market to the rental market. Investors threaten to leave market in response to policy change. As speculation continues over whether the federal government will change the 50% capital gains tax discount in its May 12 budget, investors are voicing their concern. A survey commissioned by money.com.au found that 39% of investors would refrain from buying an investment property or sell an existing asset if the CGT discount were reduced. A further 22% said they would take similar action if negative gearing concessions were reduced. Money.com.au spokesperson Nick Burgess said a reduction in rental supply would put upward pressure on rents. Some investors may also increase rents to offset the impact of these changes on their returns, or delay selling or hold out for higher prices to maintain their after-tax returns. It also raises questions about whether these changes will genuinely improve housing affordability. Not every Australian renter is in a position to become a homeowner due to lending serviceability requirements and the ballooning cost of home ownership, including stamp duty, council rates, insurance, and maintenance. Okay, let's go into this in a bit more detail. And I want to just dig into stated preferences versus revealed preferences. So, as we just heard, a significant number of investors say they'll either cancel their purchase plans or sell an existing property if the government reduces the tax concessions around property investing. But I'm wondering, how seriously should we take those claims? The reason I ask is because It's human nature to feel anxious about potential threats. Uncertainty makes us scared, but to then calm down once that thing happens and the uncertainty disappears. So, is it possible that a lot of the investors who now believe they'll sell if the government reduces the CGT discount or negative gearing benefits might change their minds and keep their properties if those things actually happen?
Well, quite possibly, because it comes down to the individual circumstance of each investor and each property. Yeah, there could be extenuating circumstances in either one of those cases, and it comes down to really what's best for them at that time based on their circumstances and the property circumstances. So, yes, but it will put another question as to for a property investor of should I buy or not? Now, if a property investor was serious about wanting to build a property portfolio, then they would actually go get some advice on how best to do that. And most of the time, buying in their personal name, which this would be the only circumstance that would affect them if they were to buy in their personal name. They might, by buying in their personal name, they might work out that it's not the best option for them.
Okay, I want us to examine both the pros and the cons of reducing the tax concessions around property investing. Let's say the CGT discount was reduced from 50 to 25% and negative gearing was eliminated. In a moment, we'll look at the negative implications of those things. Everything in life is a trade-off. So I'm wondering, what would the positive implications of making those changes be?
For who?
Well, I will let you take that question however you like.
Right. Well, there's certainly no positive implications to the property investor. It has no direct implications on the actual renter. But in the in a direct way to any renter that's renting that specific property that a property investor will own. But in the broader market, it will have a negative impact.
We'll get to
Sorry, we're
we'll
just
get to
talking
that in a
about
moment.
positive. Yeah, there's no positive impact on the
Okay.
broader property market.
Would it have a positive impact on, say, the federal budget? Would it allow the government to maybe raise some more revenue and therefore improve its budget position?
Well, I haven't got into the budget numbers and done the calculations, but they're doing when they do these calculations, and of course they're saying that there will be a positive impact on the federal budget numbers, but they're doing this based on past history of how people act in past history. Now, if a lot of investors make decisions based on the tax implications of investing, and that's whether or not they already own the property or thinking about buying property. So this can the figures that they're calculating on are not going to correlate with what happens in the future.
What about, would there be a positive impact on affordability if buyers don't have to compete? If there are fewer property investors in the market, will that make it easier for, say, first home buyers to switch from renting to buying?
Negligible, because first home buyers and also investors are quite a small part of the market, and so they're not really in a position to really make the market or not. it's when you look at the buyers in the market that really make the biggest impact. It's the uh, it's the property owners who are selling one property and moving to another, and most of them are owner occupiers. So yeah, I don't. It's we're too obsessed with first home buyers and investors. Like it's that's not the market. They're the cream on top that everyone focuses on, while the actual cake is all of these current property owners who are selling first, then buying another one.
Okay, so we've looked at the potential positives of the government reducing the CGT discount and eliminating negative gearing. What would be the negative consequences of doing those things?
Um, well, they're all basically negative in terms of to the property investor. They're going to have to pay more capital gains tax. They'll get less tax benefits if they're buying a property that is negatively geared, or they buy a property in a structure that allows them to be negative geared, which isn't all investors. And yeah, most of the smart investors aren't interested in negatively gearing anyway. So it's a mute point. But nothing will change from the point of view from a budget point of view. Um, and it's yeah, and in fact, if more investors were to buy property, then it would be better off for renters. Um, yeah, there's a no lose situation.
We've got the federal budget coming up in 4 weeks' time. I know that Jim Chalmers listens to this podcast. He appears to be still on the fence regarding negative gearing and CGT. What would your message to Jim Chalmers be?
Yeah, focus on the supply of more properties in the market, provide tax benefits to be able to um, provide more supply, and that will provide you with more tax revenue because the federal government makes a lot of money out of building more properties, and that's what we need, and that's what will help the property market and everyone trying to buy or rent a property.
Supply, you say? Well, that is the topic of our third and final story.
Oh,
I don't want to supply, but I do think you're going to like this one. Building Association reveals how to solve supply problem. The Housing Industry Association has found that up to 80% of residential land in our capital cities is marked as low density or has minimum lot size rules, which is limiting subdivision opportunities and the number of new homes that can be built in established suburbs. The HIA's Executive Director of Planning and Development, Sam Heckel, said Australia's, quote, 1950s planning rules were making it impossible to meet modern housing targets. These rules are a political choice, not a technical necessity. They were designed for a completely different time, yet governments continue to protect them even as affordability collapses. Minimum lot sizes are one of the easiest supply constraints for governments to remove, yet remain largely untouched because of political reluctance to reform suburban planning controls. Governments keep talking about affordability, but this is where it is being lost. Smaller, sensible lot sizes in well-located suburbs would deliver more homes quickly, without high-rise development and without major infrastructure spending. Concerns about overdevelopment are being used as an excuse for inaction, despite the fact subdivision is already limited by stormwater rules, flooding, demolition costs, heritage protections, and market demand. The market already decides where subdivision works and where it doesn't. What governments are doing is stopping it everywhere, regardless of context. Very interesting thoughts there from the Housing Industry Association. Owen, the HIA claims that our zoning rules are more of a political choice than a technical necessity. Is that a fair assessment?
To a point. Yes, if you look at the types of properties and where they're getting built, um, yes, they quite often you can see the political implications that would have with pumping up a particular um, electorate with lower cost housing, which would attract a particular type of voter. Yes, and we've seen it in the last federal election where the demographic of several um, key electorates have changed, and it doesn't look like it was done by accident either.
The HIA say that reducing minimum lot sizes from 500 square meters to 300 square meters would cut the land cost of a new home by more than $200,000 and would be a simple affordability lever for governments to pull. So, should they pull it?
Well, haven't they been doing that over time? I mean, it's in some areas, a 300 square meter block is the norm, is the standard. So yeah, it just depends on where you're talking about.
Well, I'm so
And
sorry to interrupt, but I think they're
yeah,
saying
yeah.
in 80% of capital city suburbs, uh, either the land is marked as low density, so the lot sizes would be bigger, and or there are minimum lot size rules. So I think they're saying in most suburbs that's not the case.
Oh yes, in most suburbs that are existing, yes, that would be the case. But in most new suburbs where
Mm.
subdivisions are happening, um, lot sizes can be under 300 square meters. So, yes, it's a bit hard to, bulldoze a whole existing current suburb and, totally redo the floor plan of lot sizes. But yeah, with new development areas, you're already getting 300 square meter blocks or 280 square meter blocks. Yeah, it's like having a townhouse um, on a on a patch of grass, but without the strata fees. So yeah, it's that's already happening in a lot of areas, but yeah, wouldn't necessarily be everywhere. And but anyone who's gone out to the growth corridors in northwest and southwest Sydney, yes, the block sizes aren't very big.
In terms of this supply problem that we've spoken about in so many episodes, where does the problem need to be solved? Is this a federal issue, a state issue, a local issue? Who bears the main responsibility for solving the supply problem?
Yeah, it's all levels of government. It's and they don't work well together. Um, and some governments are trying. It's and it's the planning of it, and it's just been pushed back and pushed back by multiple governments, um, time after time, and making it someone else's problem. And all three levels of government charge so much in taxes to be able to get these properties built. So you would think that they would be motivated to make that happen because it's easy money for them. Yeah, the cost of building, there's a couple of $100,000 in every build that goes towards taxes. So yeah.
Well, a month to go, or 4 weeks to go until the federal budget, 3 weeks to go until the next RBA decision. We are living in interesting times, Owen. We're going to keep monitoring both of those things. Thank you for your thoughts today, and I look forward to chatting again next week.
Thank you again, Nick. And yes, very much interesting times, and we'll be waiting with bated breath.